Right now, as you're watching this video, your money sitting in the bank might be in serious danger, and most people have absolutely no idea. While the headlines have moved on from the 2023 banking crisis, the truth is far more disturbing. The crisis never ended. It just went underground. Banks are playing accounting tricks, regulators are looking the other way, and there's a legal framework already in place that could let them seize your deposits to save themselves. I'm going to show you exactly what's happening, why your money is at risk, and most importantly, what you need to do right now to protect yourself. Let's dive in. Remember Silicon Valley Bank? Signature Bank? First Republic? Those failures shocked the financial world in 2023, but then something strange happened. The story just disappeared from the news. But here's what they're not telling you. The underlying problems that caused those banks to collapse haven't been fixed. They've just been swept under the rug. Regional banks across America are sitting on a ticking time bomb, and there are two massive issues threatening to blow up the entire system. The first is what insiders call the bond trap, and the second is the commercial real estate crisis. Together, these two problems have created over $500 billion in losses that banks are legally hiding from you. Yes, you heard that right, legally hiding. Let me explain how the bond trap works, because this is genuinely shocking. Between 2020 and 2021, when interest rates were at historic lows, banks did what seemed like the safe thing. They bought massive amounts of U.S. Treasury bonds and mortgage-backed securities. These were supposed to be the safest investments in the world. But then the Federal Reserve did something it hadn't done in decades. It hiked interest rates faster and more aggressively than almost any time in history. And here's the thing about bonds: when interest rates go up, the value of existing bonds goes down. It's an inverse relationship. So all those safe bonds that banks bought, they're now worth significantly less than what the banks paid for them. We're talking about over $500 billion in unrealized losses across the U.S. banking system. That's $500 billion that has simply evaporated from bank balance sheets. Now, you might be thinking, wouldn't banks have to report these massive losses? And that's where the accounting tricks come in. Banks are using something called held-to-maturity accounting, or HTM. Basically, they're saying, well, we plan to hold these bonds until they mature, so we don't have to mark down their value on our balance sheet. They're pretending these underwater bonds are still worth their full face value, even though if they had to sell them today, they'd take massive losses. It gets worse. There was a program called the Bank Term Funding Program that let banks pledge these underwater bonds at their original value to get emergency funding. But that program expired in March 2024. Now banks are scrambling to the Federal Home Loan Banks for funding, and the cracks are starting to show. Meanwhile, something called cash sorting is happening. Smart depositors are realizing they can get much better returns elsewhere, maybe in money market funds yielding 5% or treasury bills instead of the pittance their regional bank is offering. So money is flowing out of regional banks and into these higher-yielding alternatives. This creates a vicious cycle. As deposits leave, banks have less stable funding, which makes them riskier, which causes more deposits to leave. It's a slow-motion bank run, except instead of people lining up outside the bank, they're just clicking transfer on their phones. But wait, it gets even worse. The second major threat is commercial real estate, and this one is absolutely massive. Here's the shocking statistic. Regional banks hold nearly 70% of all commercial real estate loans in the United States. For many of these banks, CRE loans make up 300% to 400% of their total equity. Let that sink in. Now, we all know what happened during COVID, the work-from-home revolution. Companies realized they didn't need as much office space. Cities like San Francisco now have office vacancy rates approaching 40%. That beautiful downtown office tower might be worth half of what it was in 2019. Here's where the real crisis hits. Many of these commercial loans are 5-year balloon loans. They were originated back in 2019 or 2020 when interest rates were 3% or 4%. Now those loans are coming due and they need to be refinanced, but at today's rates of 7%, 8% or higher. Do the math. A building that was barely profitable at 3% interest becomes a money-losing disaster at 8% interest. The borrowers can't afford the new payments. The properties are worth less than the loans. And the banks are staring at catastrophic losses. So what are banks doing? They're playing a game called extend and pretend or delay and pray, instead of forcing borrowers to refinance or foreclosing on properties, which would force the bank to recognize the loss. They're modifying the loans, extending the terms, reducing payments temporarily, anything to avoid admitting the loan has gone bad. And here's the truly disturbing part. The regulators are going along with it. They're allowing banks to hide these losses because they know that if banks had to report them honestly, many would be technically insolvent. The regulators would rather let banks pretend everything is fine than trigger the panic that would come from the truth. Now let's talk about what this means for your money. Everyone knows about FDIC insurance. $250,000 per depositor per bank, right? You're protected. Except here's what they don't tell you. The FDIC's deposit insurance fund has about $130 billion in it. Total U.S. bank deposits? $17 trillion. That means the FDIC has less than 1 cent for every dollar it supposedly insures. If multiple regional banks fail, the FDIC fund would be wiped out almost instantly. But wait, you might say, didn't they bail out Silicon Valley Bank depositors even above $250,000? Yes, they did, using something called the systemic risk exception. But here's the terrifying part. That exception is discretionary. They can choose to use it or not use it. They used it for SVB because tech executives and venture capitalists were screaming loud enough. But your regional bank, your local community bank, they might not get the same treatment. And then there's the Dodd-Frank Act's Title II provision. This actually legalized something called bail-ins. Here's how it works. If your bank fails and you have more than $250,000 deposited there, the FDIC can convert your deposits into equity in the failing bank. Your cash becomes stock in a worthless, failing institution. Poof, your money is gone and it's completely legal. So what do? Here's your action plan. First, never keep more than $250,000 in any single bank entity. If you have more than that, spread it across multiple banks or use deposit sweep networks that automatically distribute your money across multiple institutions. Second, consider buying U.S. Treasury bills directly through treasurydirect.gov. You cut out the middleman, get better rates, and your money is backed by the full faith and credit of the U.S. government, not a regional bank's questionable commercial real estate portfolio. Third, if you run a business and need operating capital in a bank, consider using one of the too-big-to-fail banks. I hate saying this, but the reality is that the government has demonstrated they'll protect JP Morgan Chase and Bank of America before they protect your local regional bank. Fourth, consider holding some wealth in physical assets outside the financial system entirely: gold, silver, or even cash in a safe. If the banking system faces a real crisis, having assets you can physically control becomes invaluable. The banking crisis of 2023 never ended, it just went quiet. Banks are hiding hundreds of billions in losses, regulators are looking the other way, and the legal framework is already in place for depositors to pay the price through bail-ins. The question isn't whether there will be consequences, it's who will pay for them. Right now, the system is designed for that to be you. Don't wait until your bank is the next headline. Protect yourself now.